Guys, have you ever dreamed about asking a couple of questions to one of the best investors in the world? This is the opportunity I had. So let's dive in. Peter Lynch is one of the best investors in the world. He managed the Magellan fund from 1977 to 1990 and averaged an annual investment performance of around 29% over that 13 years period. In comparison, it is better than Buffett's annual return of 20%. However, Buffett has managed to get those outstanding results by managing a larger sum of money and over 55 years, which is a longer period of time. Peter Lynch is also the author of the best-selling investment book called One Up on Wall Street. And if you are really serious about making money, I really recommend you to read it. I managed to get an interview from him, and there are really three key things that we tried to cover. The first point is how you can beat the market as a small investor. The second point is how important it is to understand the company you invest in. And the third point is how can the small investors have an edge over the professionals. Let's get straight into this interview. Peter, before we start this interview, let me thank you for your time. I'm really thankful to have the opportunity to ask you a couple of questions, and I know that you are extremely busy, so thanks a lot for taking the time to answer a couple of my questions. Let's go through them, and the first one is, as small investors, do we really have a chance to beat the professionals?
I frankly think it's a tragedy in America that the small investor has been convinced by the media, the print media, the radio, the television media, that they don't have a chance. That they don't, the big institutions with all their computers and all their degrees and all their money have all the edges, and it just isn't true at all. And when they're convinced, when this happens, when this occurs, people act accordingly. When they believe it, they buy stocks for a week, and they buy options, and they buy the Chile fund this week, and next week it's the Argentina fund, and they get results proportionate to that kind of investing. And that's very bothersome. I think the public can do extremely well in the stock market on their own. I think the fact that institutions dominate the market today is a positive for small investors. These institutions push stocks on usual lows, they push them on usual highs. For someone that can sit back and have their own opinion, know something about industry, this is a positive. It's not a negative.
Okay, I see. This is quite interesting. My second question would be, what would be the most important thing to know as a small investor?
The single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say the reason I own this is the sucker's going up. I mean, that's the only reason. That's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it. And that's true, I think, about 80% of people that own stocks. And this is the kind of stock people like to own. This is the kind of company people adore owning. This is a relatively simple company. They make a very narrow, easy to understand product. They make a 1 megabit SRAM, CMOS, bipolar risk, floating point, data I/O array processor with an optimizing compiler, a 16 dual port memory, a double diffused metal oxide semiconductor monolithic logic chip with a plasma matrix vacuum fluorescent display. It has a 16-bit dual memory. It has a Unix operating system, 4 whetstone megaflop polysilicon emitter, a high bandwidth, that's very important, 6 gigahertz, double metallization communication protocol, an asynchronous backward compatibility, peripheral bus architecture, 4-wave interleave memory, a token ring interchange backplane, and it does it in 15 nanoseconds of capability. Now, if you own a piece of crap like that, you will never make money. Never. Somebody will come along with more whetstones or less whetstones or a bigger megaflop or a smaller megaflop. You won't have the foggiest idea what's happened. And people buy this junk all the time.
Okay, so if my understanding is correct, we should buy simple stocks and not overcomplicate things. Can you give us some example of simple stocks that were big winners for you?
I made money in Dunkin' Donuts. I can understand it. When there was recessions, I didn't have to worry about what was happening. I could go there and people were still there. I didn't have to worry about low-priced Korean imports. I mean, I just didn't have, I can understand it. And you laugh, I made 10 or 15 times my money in Dunkin' Donuts. Those are the kind of stocks I can understand. If you don't understand it, it doesn't work. This is the single biggest principle. And it bothers me that people are very careful with their money. The public, when they buy a refrigerator, they get a Consumer Reports. They buy a microwave oven, they do that. They ask people what's the best kind of radar range or what kind of car to buy. They do research on apartments. When they go on a trip to Wyoming, they get the Mobile Travel Guide, or California. When they go to Europe, they get the Michelin Travel Guide. People will hear a tip on a bus on some stock, and they'll put half their life savings in it before sunset, and they wonder why they lose money in the stock market. And when they lose money, they blame it on the institutions and program trading. That is garbage. They didn't do any research. They bought a piece of junk. They didn't look at the balance sheet, and that's what you get for it.
Okay. You mentioned the word research in a couple of your responses. Why is it so important for you?
Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated. People get too carried away. Another key element is that you have plenty of time. People are in an unbelievable rush to buy a stock. I'll give you an example of a well-known company. Walmart went public in October of 1970. 1970 went public. Already had a great record. It had 15 years performance, great balance sheet. You could have waited 10 years saying you're a very conservative investor, you're not sure this Walmart can make it. You want to check, you see them operate in small towns, you're afraid they can only make it in 7 or 8 states, you want to wait till they go to more states. You keep waiting. You could have bought Walmart 10 years after they went public and made 35 times your money. If you bought it when they went public, you would have made 500 times your money, but you could have waited 10 years after Walmart went public and made over 30 times your money. You could wait 3 years after Microsoft went public and made 10 times your money. Now, if you knew something about software, I know nothing about software. If you knew something about software, you would have said, these guys have it. I don't care who's going to win, Compaq, IBM. I don't know who's going to win Japanese computers. I know Microsoft, MS-DOS is the right thing. You could have bought Microsoft. Again, I'm repeating myself, stocks are not a lottery ticket. There's a company behind every stock. And you can just watch it. You have plenty of time. People are in an amazing rush to purchase a security. They're out of breath when they call up. You don't need to do this.
Okay, but it takes time though to do research. So how can we facilitate this part of the process?
You need an edge to make money too. People have incredible edges and they throw them away. I'll give you a quick example of SmithKline. This is a stock that had Tagamet. Now, you didn't have to buy SmithKline when Tagamet was doing clinical trials. You didn't have to buy SmithKline when Tagamet was talked about in the New England Journal of Medicine or the British version, Lancet. You could have bought SmithKline when Tagamet first came out, a year after it came out. Let's say your spouse, your mother, your father, you were a nurse, you were a druggist, you're writing all these prescriptions. Tagamet was doing an amazing job of curing ulcers, and it was a wonderful pill for the company because if you just stopped taking it, the ulcer came back. See, it would have been a crummy product that you took it for $1 and it went away. But it was a great product for the company. But you could have bought it 2 years after the product was on the market and made 5 or 6 times your money. I mean, all the druggists, all the nurses, all the people, millions of people saw this product. And they're out buying oil companies, or drilling rigs, It happens. So you only need a few stocks in your lifetime. They're in your industry. I think of people, if you'd worked in the auto industry, let's say you're an auto dealer the last 10 years, you would have seen Chrysler come up in the minivan. You've seen, if you're a Buick dealer, a Toyota dealer, Honda dealer, you would have seen the Chrysler dealership packed with people. You could have made 10 times your money on Chrysler a year after the minivan came out. Ford introduced the Taurus Sable, the most successful line of cars in the last 20 years. Ford went up 7-fold on the Taurus Sable. So if you're a car dealer, you only need to buy a few stocks every decade. When your lifetime's over, you don't need a lot of 5-baggers to make a lot of money starting with $10,000 or $5,000. So in your own industry, you're going to see a lot of stocks, and that's what bothers me. There are good stocks out there looking for you, and people just aren't listening, and they're just not watching.
Okay. Thank you for your time, Peter. It's really, really appreciated. Before we leave, I would like to tell you that I'm a huge fan of Warren Buffett, and I recently had the opportunity to interview him. because you influence my investing practice as well, I asked him what he thinks about you. So this is his answer.
I know Peter. I don't know him well, but we played bridge together in Omaha, as a matter of fact. And I like him personally, and obviously he has an outstanding record, and he has written those 2 books which have been bestsellers about his investment philosophy. I don't really have anything. I'm not going to embroider on his. There's certainly a fair amount of overlap. There's some difference. Peter obviously likes to diversify a lot more than I do. I mean, he owns more stocks than the names of companies I can remember. I mean, but that's Peter. And I've said in investing in the past that there's more than one way to get to heaven, and that there isn't a true religion in this, but there's some very useful religions. And Peter's got one, and I think we've got one that's useful too. And there is a lot of overlap. But I would not do as well if I tried to do it the way Peter does it, and he probably wouldn't do as well if he tried to do it exactly the way I do it.
Those were massive practical tips we received from Peter Lynch. Before we leave, let's make a quick recap of the insights we can leverage from this interview. And there are really 3 key insights that you need to remember. The first one is that you can beat the professionals as a small investor. The second one is you need to understand what you own. And the third and final one is you will find your best ideas within your circle of competence. This is it for today, guys. I hope that you liked this video. If this is the case, feel free to drop a like. And if you want to receive more contents like this, feel free to subscribe. Thank you all. Have a good day and peace out.